Today I have a secret tax hack to build generational wealth. So this is for all of you guys who are building wealth yourself, obviously, and you want to get it down to the next generation in the most efficient and a tax efficient manner, right? So any of you guys with kids, essentially, this is pretty much how it goes. So there's a little thing called the cost basis on certain account types, and then there's a stepped up basis in the tax code that you can reference here. So specifically, I'm talking about brokerage accounts today and real estate, and that is it. So we're not talking about 401ks, IRAs, any kind of pre-tax, et cetera accounts there. We're not even talking about Roth accounts, which are fantastic as well for estate planning. But we are simply talking about brokerage accounts and real estate here, stepped up tax basis. So, for example, let's say you buy a house for $200,000, and then and you're gonna hold it, right? Just sit, hold it, do your thing, whatever, collect rent, etc. And now, time travel down the road, and you're older, and now it's worth $400,000. You have $200,000 of gains there that if you were to sell it in your lifetime, you would owe capital gains on, both federally and the state, if applicable. So again, if that transacts during your lifetime, you owe that capital gains. Now, let's say you just keep holding it until you pass. Say it's 400 grand when you pass and you bought it for 200, right? You do have $200,000 of capital gains there. What you're going to have is a transfer on death, essentially, is what it's called, TOD. You want to list on these things. What that means, it's going to transfer to that person upon your death. That person's going to receive it at a stepped up cost basis, meaning they're going to get it at the $400,000 mark because that's what it was worth when you passed away. And this, again, could be your child or whomever, really. And there's going to be no tax due on that. Now they're going to hold it. So now, if they sold it, a few years later, let's say for 500 grand, and they inherited that from you, they have $100,000 of capital gains that they're going to have to pay tax on. But if they do the same strategy and they hold it again, assuming no law changes, essentially, in the tax code, which always could happen, but assuming there are no changes in the tax code, the stepped up cost basis is there, and that's how you build generational wealth from down again. The same is going to apply to brokerage accounts. So again, not 401k, not IRA, not TSP, not even Roth, etc. Just regular old boring brokerage accounts have this. They are treated the same essentially for taxes. So you could have a bunch of stocks or ETFs that have appreciated over the years to a significant level, and we can use the same math. Maybe you have $200,000 of ETFs, and now they're worth $400,000 that you're passing. They're held in a brokerage account. If you liquidated those in your lifetime, yes, you would have capital gains. Same thing, federal, state. If you didn't, your beneficiary on that account, who, again, that TOD or beneficiary you can list on there, gets it at the stepped-up cost basis of what it's worth today at the time of your passing. So pretty neat, no tax due on it. So if they want to be smart, again, they'll just kind of live off the dividends along the way. They'll hold it until they pass and give it to their kids or whatever too. So it's a great way and very efficient way to build generational wealth just in those two things. So buy real estate, get some money into a brokerage account. That's why I encourage all my clients to have a few different kind of account types for that matter. So obviously they're doing their 401ks first. We have IRAs we've rolled stuff over into. We have a Roth we're contributing to as well. And then we have a brokerage account for that reason, amongst many others. So happy planning, guys. My name is Justin Hodges.